Check, check. Is anyone who's on this virtually getting audio?
I'm getting audio, yes.
Huh.
Yes.
Okay, I'm not getting any audio. I'll disconnect and reconnect. Thank you all.
I don't believe they've connected the audio yet.
I see. So you can hear me, but sorry, I think you're muted, just like I was. I
Yes,
apologize.
I can hear you.
Okay, but you can't hear what's on the screen either?
I
Correct.
think I think they've not connected the audio yet.
Okay, thank you. I just know we had this difficulty last time. I want to make sure.
Kind of a perspective of what the brokers are dealing with and some boots on the ground issues that they're dealing with, and then we can open it up to questions. It's very, kind of easy, loose discussion here. And for those that are online, if you would like to ask questions, just raise your hand and I can see you and I will get to you. So we'll send it over to Julie and Sam. Thank you.
Okay, good. I'm Julie and Sam, and this is Sam with IMA Financial Group. So we're out of Wallingford, Connecticut, our office, but we are nationwide here. Little background, Sam has been with IMA, I think 15 years now, so has a plethora of experience in the commercial insurance industry, does have a focus on nonprofits here, so can answer any questions there. We are headquartered out of Denver, so do have a national presence as well. I'm going to bring that perspective to you all, as well as the local perspective.
Right. So, as part of our nonprofit department, we have a whole team that backs Julie and I up. These are the faces. There's many more. Any client that we have for nonprofit with IMA gets obviously Julie and myself, but they also get a plethora of resources, including claims handling, loss control, contractual review. So all of those are services that we provide to make everything easy, because we don't just consider ourselves transactional insurance brokers that go and get you a policy and say, here's the premium, here are the limits. We're a risk management consultant. And as part of that, insurance brokering is an aspect of our job. So we put together an extensive agenda, which hopefully doesn't hurt everyone's eyes. But we want to make this as interactive and answer as many questions as we can. So of these topics, is there anyone you want to particularly start with? Do you have any questions that you want to start with? Is there a topic not on our agenda that you want to discuss? How do you want to, or we can just go through?
Any comments from anyone?
Okay.
What does SAM stand for?
Sexual abuse and molestation, which is a component of nonprofit insurance that is particularly difficult right now. So we wanted to highlight that as we go through our
Why don't you go ahead and do this, and if we have any questions as we go, people can raise their hands.
Sure.
And we can ask. Michael, did you have a question?
I merely wanted to say that in the interests of time, and because you've got a very full agenda at the conclusion of this, Rep Wood, I'd like to hear from these folks who are placing brokers what the challenges are for tax-exempt social service agencies. If by going through SAM claims, that touches on that, that would really be a help to me.
Yep, that we would definitely be touching on that throughout this presentation.
Okay, go.
So, industry overview, nonprofit. That's a really broad term. It's like saying real estate or construction. We know there's many different aspects of nonprofit insurance, and different verticals within the nonprofits insurance field have different challenges or don't have challenges. So what we find in the nonprofit space right now is the majority of nonprofits are not having incredible headwind when it comes to insurance. The market is relatively stable. on both the property and the casualty and the executive liability lines for clean performing accounts. Where we have more difficulty in the nonprofit space is, one, if you have claims, or if your risk management procedures are not up to date. And two, if you're in a particular segment of nonprofit for social services, meaning mostly adoption and foster care type operations. So what we see from a headwind perspective in the insurance marketplace is not really that different from any other insurance vertical that has difficulty. The insurance companies are for-profit businesses. If they believe they can make return on investment in its particular vertical, there will be a number of suppliers in the marketplace to keep up with the demand of insurance. Where we get more challenges is when we have accounts that have claims and haven't done anything about them, haven't changed their procedures, haven't improved any operation. And again, where we have those social services, where we're seeing, the reason those are in particular a little more challenging is because we're seeing more claims in that space. And that's where the sexual abuse and molestation component comes in the most, because we're seeing increased claims activity within that space of insurance. And that tends to be involved with more, from a probability standpoint, more with the human services type nonprofits. So any questions on that? Do we have any nonprofit representatives here that have human services or social service, foster, adoption care, things like that? We do. Okay. So this is what we're kind of seeing in the marketplace. We're seeing the claims rising, which is having a ripple effect across the whole industry. And what that means is higher premiums, restrictions on coverage, and a shift to the surplus lines markets from the admitted space. So instead of your Hartfords and your Travelers and the insurance companies up in the city quoting these types of accounts, we're seeing your Beasleys, we're seeing your Stars, maybe ones that you might not have heard of. They have a very important role in the marketplace. But obviously the admitted insurers, the ones you see commercials for, can usually offer more comprehensive coverage at a better price. So if they're not in the market space, it creates challenges, because now we're dealing with less coverage and more premium, as we said. We're also seeing these insurance companies really want to dig into the risk management procedures of these nonprofits. And that's going to flow into our process and how we think of buying insurance. The days of an Accord application and loss runs for insurance quotes are gone. If a broker comes in and tells you, yeah, we can get quotes, all we need is just basic information, they may be able to get quotes doing that, but they're not going to be the best quotes. The key in this marketplace, when we have lack of supply, is how do we best tell the story of the organization to the underwriter so that they feel comfortable with the fact that the operation runs well, they're not going to have claims, they're not going to pay expenses, and they're going to make money on the account. At the end of the day, insurance companies are for-profit businesses. Please.
Thank you. So I'm Kathy Austin. I actually brought this issue up a couple of years ago, and Representative Wood has been kind enough to hold hearings on it. But it's a very serious issue. But you say that insurances are for-profit businesses. I get it. Mm-hmm. I also don't get it, because I don't have insurance so you can make money. I have insurance to protect the issues that I have. That's not, that to me,
it's a diametrically opposite
correct
objective.
And I'll tell you, my insurance on my house went up $1,000 and I've never made a single claim. Mm-hmm. Not one. Mm-hmm. $1,000 a month. Mm-hmm. Not $1,000, $1,000 a month, and I'm a poor person. I can lose my house because you want to make money. Mm-hmm. So I have to tell you, I just don't get it. I really don't. And I'm not trying to be disrespectful, but I'm not. We, our nonprofits, our human services nonprofits, are taking care of a societal need that we have. Again, not designed for you to make money, but designed for us to protect the basics of those services. Like, we can't keep a sex offender who is not sentenced to life in prison. We have to let them go. And if we have these organizations set up that can have services for them, then that's better than putting them out on the streets with no services, which again, your company can make money on that, but they're certainly not going to be happy when their CEO family gets attacked because we haven't protected them by providing good services for someone and having someone be successful. So I really have a hard time with, because you've said it 50 times since, and you've been only speaking for about 5 minutes, but at least every other sentence said, we're a for-profit business.
Well,
So I just, I'm of the mindset to say, geez, I don't know that insurance companies should make money like this. It's not helpful. It's really not, there has to be some give and take here. I'm okay with a business making money. I'm not okay with you making billions of dollars, and every time someone makes a claim because their faucet overspilled on a floor, their insurance goes up. And I think that my insurance went up because I have a very old house, and you're looking at replacement costs. Well, you might find somebody else to be replaced as the owner of that property because no one's going to be able to afford it. And I need nonprofits to stay in business. I really do.
And Senator, if I could just jump in for a second, this IMA is a brokerage company,
Right.
so they are not the insurance carrier.
I
They're
understand that,
finding
but-
they're finding products and tailoring them, and they specialize in the nonprofit. So they're just here to give us like a state of what they're
I
dealing
know,
with.
but he doesn't have to say every other sentence, we're a for-profit business, and that's what we're here for. There is something that has to be decided on the need of the community. I mean, it's a problem if nobody can afford your insurance. It's a problem if the needs of the society are not being met because we have put profits ahead of the need of the society. And that's what we're doing here. We're making a decision based on a profit mechanism, not a need of what we have going on. I personally want to see nonprofits, the nonprofits stay in business. I don't look on them as nonprofits, by the way. I look on them as small businesses. They employ a lot of people. They take care of a lot of things. I think it's a misnomer to call them a non-for-profit because, they're not really, they're much more than an amorphous organization. So I just would ask that you kind of keep that in mind as we're talking about this. I get it. We can make fancy pictures and we can do that kind of thing, but I'm going to try to figure out what we're doing so that we can have some sort of coverage for some people on this. Someone who has developmental disabilities, for example, you talked about sexual assault and molestation. Some people that have developmental disabilities have a problem controlling themselves. They're not going to jail because they have developmental disabilities. They probably have an IQ. In Connecticut, they would have an IQ of less than 69 or less. They're not going anywhere, but they may have problems controlling their conduct.
Sure.
So I just am, I'm a little bit disenchanted with, and I've been involved with Representative Wood on costs for insurance companies. I'd like to take away all of what we call public benefits, but at the same time, I still want to be able to provide them with some sort of coverage. And so what I would ask is that you give me an idea. The risk management on someone who is a sex offender that's a DDS client, there is not much you can do other than hire somebody on a one-on-one and make sure that he or she never is by themselves. That's the only thing you can do. And you can only do that if you can afford to pay for staff. And you can only afford to pay for staff if you're not paying exceptionally large dollar amounts to for-profit businesses.
Rep Wood, this is Mike McGlaris. May I try to refocus with just one quick question, please?
Sure.
I'd like to go back to the presentation and ask my colleagues from IMA to focus on their slides as respects what is perceived by us as members of this committee to be an existential crisis. It's not an existential crisis for a very large hospital system with a captive insurance company and access to Lloyd's and reinsurance markets. It's tough in some respects, but it's not existential. In social and behavioral and human services, I think these broker colleagues would agree that it's becoming an existential crisis, the availability and affordability of insurance coverage. Could they possibly either comment on it or take us to a slide that would help us understand it?
Sure. So, what we can skip to here. These are the rate trends. I'm just going to sit on this slide for a second, just respond. So, Kathy, we agree with you, 100%. We're the broker. We don't make the market. We only can give you guys a glimpse into what the market is. And the reason I kept harping on the for-profit business aspect, and I'll try to make that the last time I say that word.
I don't think that'll be it, but
We have a macroeconomic issue in the insurance industry, and it's not just for nonprofits. I have a client in real estate who called me the other day and said 3 of my buildings can't pay their premiums. Their premiums are too high. This is across the insurance industry.
right.
And so all we're trying to do is tell you why the market is the way the market is. It's not that we agree with it. It's not that we like it. It would make our jobs a lot easier if it wasn't this difficult. All we're trying to tell you is why it is the way it is. And to Michael's question, for some of these small, the behavioral science, the social service, smaller, we'll call it, the operations, the way that I'm going to skip ahead. The way that we save insured's money, the way that we bring down cost is IMA in particular, I can't speak for the rest of the industry, comes in and we understand your business in the most comprehensive way that we possibly can. And that's how we make our pitch to underwriters. We don't, what I was saying before where, brokers say, here's an application, here's your claims history, please give me a quote. That doesn't work anymore with costs the way that they are. The way that works is, here's my accord and here's my loss history, but here's all of the details of the claims I have and here's what we've done to rectify so that they don't happen again. Here's a copy of our background check procedure for when we hire employees. Here's our waivers. Here's all of this data that will get the underwriter comfortable with the fact that they either are looking at a best-in-class risk and they want to quote it, or they're looking at a company that maybe had some problems but is taking it seriously enough to address it, and that partnership with the insurance company is what will bring down their expenses in the future so that they can be a better risk in the eyes of the insurance company. So I started my career as an underwriter. I've been on the other side of the table. I haven't been a broker my whole career. An underwriter has a stack of submissions up to the ceiling of different accounts that people want them to quote. They don't get paid to write more business for the most part. Different insurance companies are different. So what their objective is I want to write the best risks. I want to go to my underwriting manager with the best submissions so that we can get the most accounts on the book that make us, what we're able to do as an insurance company. And so the way that when I was an underwriter, the submission I would pick off the stack is the one with the most information. It's the one that I feel the best about pitching to my superiors about why we should write this risk. So the key is, in order for Michael to get the best rates and to get the best coverage for these smaller operations, you need to come with a compelling story to the insurance companies. And that's combined with creativity by the broker in the marketplace to say, hey, maybe Philadelphia is quoting my nonprofit insurance, but maybe their rate for directors and officers is high, and I can get that better quoted with Great American, another insurance company. I'm going to split the directors and officers out, and I'm going to quote it with Great American, and I'm going to leave everything else with Philadelphia. Or I'm going to take a higher deductible, and I'm going to take more risk, which will bring my premium down. I'll take different limits. There's many different ways that can be structured. So if any broker is giving their nonprofit client a quote and it's just what they had last year, one option, that broker is not doing their job. They're not, go ahead.
I wanted to ask, because one of the recommendations that we're going to be talking about later after your presentation is how we work with the nonprofits to reduce their risk profile. Do you, as brokers, consult them on that? And
Yes.
if you do, what are some of the things that you've suggested?
So what we suggest, we do that. And actually, we have a process that we do ourselves. I don't know any other broker that does this, where we come and sit with the user buyers, the operators of the company, and we do an interview with you. And we learn all about your business as best as we can. And we use that to put together what we call a risk profile. It's funny you use that term. And it's an addendum to our submission of all of the information that we found during our interview process. And so what we dig into during that, which is the answer to your question, is we dig into your hiring process. That's important. Who are we hiring? What contractual, do we have waivers? Do we have any contractual agreements that put risk to another party that isn't us, so that if a claim comes in, it can get tendered to a different party? We look at operating procedures. We look at risk management procedures. We try to be comprehensive in understanding all aspects of the business and knowing what underwriters are looking for. It's kind of a reverse engineering of the marketing.
And can you give us an example on what that third-party risk profile would be? Like, what is that real-life example? Like, is it like a food service, and, you know, what that contract with them looks like? Is it outsourcing medical care? Like, can you just give us the real-life stuff?
Those are both good examples. I'll give you one more. If we are transporting people, but we don't own our vehicles, and we sign up with a contractor that does the transportation of people, the contract with that is critically important, because if that driver gets in an accident and we don't have the right contract, our insurance company is paying that claim. But if we have the right contract with the right indemnification and hold harmless language that puts the auto carrier as the primary insurer, then we can tender that claim to their insurer, and it keeps our loss run clean.
I just want to follow up on that. I'm sorry, because we're getting into the meat of the issues that we're hearing. Would an operator of a service be better served of creating another business to do transportation rather than have it be under their umbrella, you know?
It's
and
hard.
Is that something that you recommend?
It's hard. We'd explore it, but what I would tell you is, if we're creating a new entity for auto, that creates different challenges, which is the fact that we have no insurance history. So the loss run isn't just your claims history, it's your insurance balance sheet, essentially. And so if we create new entities and we say, hey, we want to go to the market, and that way we're not tied to our old history, it actually, from the underwriting perspective, they'll say, well, we're actually going to charge you a little more because we don't know how you perform. So it's a creative idea. It's something that the broker should be showing you so that you have transparency into the marketplace. That's key. You need to know what the marketplace looks like. And that's why getting one quote isn't acceptable. So there should be a number of different ways such as that you carve the program up to see what the most cost-effective way to purchase the insurance is.
Rep Wood, if I could ask the gentleman a question.
Please, go ahead.
In this side-by-side example on the screen that we're all looking at,
Mm-hmm.
I'm trying to find what I think is a major problem that needs assessment on the left and resolution on the right. And by the way, I don't have the answer to this major problem, and that is contracts that require the indemnification of the state of Connecticut.
Mm-hmm.
Could you comment on that, please?
Could you elaborate a little more on the question? I'm not sure I quite understand.
The question is a social service agency or other agency dealing with adoptive care, et cetera, where there may be a contractual requirement in return for grants funding from the state of Connecticut, that the state of Connecticut is indemnified
Yep.
by that entity's insurance policy.
Mm-hmm. Yeah, I don't see that particular example being as scrutinized by the insurance companies. I don't think, it's one thing if we're adding the state of Connecticut in order to get grants. Nonprofit insurers understand that, and that's cost of doing business, that's standard operating procedure. Where I would see different problems, I'm going to use that same auto example so we all stay on the same page, would be if we were indemnifying the auto carrier and now all of a sudden we have an auto claim and we have it in our contract that we're responsible for it and we can't tender that claim. That's where I see more of the issues from an indemnification. It's us taking on more contractual responsibility than we really should. It's not like the state of Connecticut, for grant purposes, is taking on additional exposure. That's just standard operating procedure. So I think I'm answering your question, but to directly answer it, the idea of contractual risk transfer when it comes to this operation, nonprofit operation, or any other, is to push claims to different insurers in order to keep our claims history clean. And how we do that and how acceptable other parties are to that depends on our relationships, our contract negotiations, things like that.
So if I could, as a follow-up, I'm very interested in having your views, and I'm very respectful of them. But you've had colleagues appearing before us and testifying exactly to the opposite of that opinion.
Correct. My name is Lisa DeMattis Lepori. I'm the CEO from The Connection. It's nice to meet you. The reason why I'm in this committee is because we have been around for 55 years in Connecticut. We have 50 treatment programs. We serve a variety of different populations. We had an extremely large claim last year that caused our insurance company to drop our insurance at the very last minute because of this claim, and which meant that my organization was going to close, completely close down. We served over 12,000 unduplicated Connecticut residents last calendar year, so we are large, and we had to go into the secondary market to a tune of over $900,000 of our insurance cost. What I want to say, though, is that our insurance company, because of this claim and the high profile of this certain issue that occurred, they got extremely involved and they were upset with the indemnification language that we have in our contract. They had said at one point that if the indemnification language had been changed, they would reconsider keeping us. And we spent a lot of time at the LOB, and a lot of people that are sitting in this committee right now were wonderful and helped us, and we're very grateful for that. But what I will say is we had 17 brokers that turned us down because of this one claim. Keep in mind, we did not have any type of large claims prior to this one event. So the indemnification, in fact, was a massive issue for our insurance company. They were very upset.
I would need to understand more of the nature of that claim, but what was the actual issue with the indemnification?
The issue with the indemnification language is that they were upset that that our funder, the state, was not being held responsible for. We were taking I'm not blaming anyone. I'm making a point. The insurance company was upset and felt that the state should have taken more responsibility for this specific case. It was a sex offender. They were upset about the history of this person. They were upset about all kinds of things related to the case. So they got very overly involved during the whole year of search, et cetera. But what I want to say is the state, it's not the state's fault. The state was very supportive of the connection. They helped us. They were wonderful. I'm not bashing my funder. They're really fantastic. But I guess what I'm trying to say is that from the insurance company's perspective, the insurance company was upset about it. We weren't upset about it. I'm not complaining. I'm just letting you know that that specific insurance company was blaming the state, not the connection, the insurance company. And maybe they just used that as something that they were upset about, but they didn't understand that. They had a massive problem with it.
Let me ask one more question, then I'll provide a response. did they know about how the indemnification was, how it was written before the claim, or were they finding out about that during the claims process?
Oh, they found about that during the claims process.
Okay, so I'll say a couple things. One, hold harmless and indemnification language should be reviewed by the broker and by the insurance company prior to any implementation of any policy. Everyone should know how the contract reads before we enter a new agreement, because that obviously, in your example specifically, it becomes critical in the event that we have a claim, what the
Right.
contract reads. The other thing I'll say is, in my experience, and I've been doing this for a long time, if you explain to an insurance company, hey, we have this contract written this way because this is the way we access state funds, or grant funds, I should say, how are you okay with that? How would you change it? Does your in-house counsel have any comments on how we can make this better? Because if we don't have the contract written this way, we don't get funded.
Right.
So it becomes a collaborative process with the insurance company. So I can't speak to what other people have said to you guys.
Of course.
But in my experience, these are things that get addressed throughout the quoting process, so that there's no surprise when you have a large claim. Everyone knows where they're going and what they're doing. So, and when it comes back to, the fact that, hey, at the end of the day, we have to comply with the state in certain areas, otherwise we don't get funding.
Right.
If your insurance company doesn't understand that, then it's the wrong insurance company, and the
Yeah.
broker's not doing the right job.
Yeah. Thank you.
Can I just ask, I'm sorry to put George and Terry on the spot, but can I just ask you to chime in on that? Was there some process not properly followed when Lisa's policy was put in place to have her get dropped like that? Because if this should have been reviewed up front, do you agree that should have been, reviewed
You're
up
talking
front?
about the limitation.
The connections, dropping the policy after the large claim happened.
Well, we'd have to look at the circumstances regarding her specific account to understand how the company terminated it. Did they terminate it correctly? Did they provide the appropriate number of days?
Lisa hit on something real quick. Are they just using that as a different excuse because they don't want to get out of that vertical of insurance, or because?
Well,
there's
that all has to be looked into, but the companies have a right to determine if they want to continue on a piece of business, and if they paid a sizable claim, they're gonna we've paid here, and we're moving on from this account.
Okay.
Yeah.
It's, that's generally, and they have to follow the procedures, but they can get off a risk if they paid, sizable losses or a loss. They can say,
Yeah.
we're done.
Lisa, can I ask you another question? How long
Sure.
were you with that insurance company?
Oh, I don't know exactly, but it was a long time.
Because the other aspect of this is all of this additional work that has to be done by you guys is relatively new to the marketplace. So Lisa, if you were with that insurance company, I'm making the year up, in 2018, this probably wasn't a big concern at that point. But now that the insurance market has hardened, and now that we have a restriction of supply, and we have to be a little more, we have to do a little more work to put the best foot forward, these additional measures are being scrutinized in a way that they haven't been previously. So it's possible your broker just said, hey, you guys, you've written this account for 10 years. You know everything that's going on. And then when we had the claim, that's when we dug under the hood and we found, the contractual language.
I want to disabuse, please, I want to disabuse everybody in this room about the notion that this insurer was unaware of the extent of state indemnification in a contract. This was, and still in some respects remains, the leading insurer of social services. It flies in the face of reason that they were unaware of contractual and indemnification clauses in these contracts for grantors. Period, paragraph, end of story. What this was, pure and simple, was a large loss that over 20 years of insurance renewals would never have been recouped. And this company moved on. That's the story.
Fair enough.
The
Understood.
the other thing that I know we have to move on, but the big concern obviously is we go through a robust risk profile analysis. We have a large risk department at the connection. I think we have 10 people. I mean, we jump through the hoops. What if this happens? What policies do we have? All the things that we do, etc. But what I want to say, and my concern as a CEO, being at this agency for, 30 years, not as a CEO, but for 30 years, I've been at the Connect over 30 years, is this. The clients are getting harder to deal with. You're never going to predict. You could have every safeguard in place. It's not going to be a matter of if, but when this is the reality. This specific insurance company insures the majority of the nonprofits in Connecticut. That's a concern. I know from my peers. And the bottom line is, it's not just foster care, right? So we're talking about, yes, that's an issue, but we heard about, well, why residentials are high risk. Sex offenders are high risk. Anyone with mental health is high risk. Community justice is high risk. They're all high risk. You could be running a women's residential program. I just want to say this and then I'm going to go off my soapbox. You could be running a women and children's residential program, right? People look at like, oh, they look at that in a better way than a sex offender program. That's just reality. That's lower risk women and children, not necessarily. You could still, you could have potentially anything could go wrong. So I think it's like you're like a sitting duck, right? This is a massive problem in Connecticut. Nonprofits are not going to be able to stay afloat and continue the good work that we do because we do wonderful work. No one goes in the business for there to be a catastrophic loss, a murder, anything go wrong. That is not why we're here. We're here, in fact, to do the opposite, right? And make citizens healthy and well and give back to society. And I have thousands of stories over the years to tell you of people that have been clean and sober, master degree, that have books published, on and on clients, right? But again, we're not going to save everybody. I don't know what the answer is, but Connecticut is at risk. That's the bottom line, and we need to come up with a solution. Thank you.
I don't disagree with you at all. And Julie and I do a lot more than nonprofit insurance. We happen to have a particular niche in this industry. What you just described, Lisa, is true of the entire insurance industry right now. It's not just nonprofit. Kathy made mention of her homeowners insurance earlier. The homeowners insurance market, I'm sure everybody in this room, their premium has gone up over the last few years. We have a macroeconomic problem in insurance, and the solution in most cases is not necessarily going to be done by insurance companies. It's going to be done by potential tort reform or potential, pushing more insurance companies into certain marketplaces. There's no great answer for this group on how we're going to fix the insurance industry because it's not
I'm sorry, I don't mean to interrupt, but we really can't hear you very well online. If you could just get your mic a little closer, perhaps.
Yep, no problem. Is that better?
Oh, that's so much better. Thank you.
Okay, no problem. Hope that wasn't the whole time. So it's much deeper than just this vertical. And we're incredibly empathetic to all of the policyholders that are affected by this industry because it's a necessary industry in our society for a lot of different reasons. And as brokers, we wish we had more control over the marketplace. But until we get insurance companies to understand the impact that they're having on society at large, I'll say, all we can do as brokers is make the best of what we have on our plate.
Thank you, Sam. I'm going to ask if we can open it up for questions, and then if you guys need to reference slides, please feel free to do that.
Yeah, I'll bring them up.
Maggie, I see your hand up.
Hi, thank you for the presentation. When you talk about these macro forces, I mean, one thing I'm thinking about is climate change and the horrific, weather that comes across, fires and, storms. Is that one little tiny slice of it? Is it a fairly substantial part of it? And what are the other forces and factors that are pretty much altering the insurance industry?
Sure. So no, the climate change and the increased property claims is a major part of it. The California wildfires are billions and billions of dollars of insured losses. And what that does is the insurance companies pay, but there's a level of insurance above your Travelers, your Hartfords, and that's called reinsurance. And there's only a few insurance companies that are the major players in reinsurance. And so when these catastrophic claims, the wildfires, the storm we just had over the weekend, when these come in, many times the insurance company that you're with is paying your claim, but they're being reimbursed by the reinsurance company. And so when the reinsurance companies are the ones where the claims expenses rack up, that's where you see a ripple across the whole marketplace. For property insurance, that was a really hard market nationwide, meaning high cost, not a lot of supply, because of these catastrophe claims. And we're seeing a bit of a softening of that over the last few months, which is good. But in addition to climate change, listen, all of the insurance companies can give you data on this. We just have more claims than we used to, more frequency. And when we have more frequency, by probability, we have more severity. The slip and fall that was settled at 25,000 10 years ago is now 150,000 with inflation. We also have an element of, oh, sorry. I'm not used to talking into the mics. We also have litigation financing. We have companies coming in and financing plaintiff suits. And not saying that the plaintiff suits aren't warranted. That's not what I'm saying. It's just that we have outside money coming in to fund these claims. And because of that, we're seeing more claim severity and frequency. So I'll give you an example right across state lines in New York. There's a law in New York, labor law 240 and 241. Is anyone in this room familiar with that? All right, so in the state of New York, if a contractor's employee gets injured from height, in 49 other states, they collect workers' comp, and that's their sole remedy for insurance. In New York, only state that still has this law, they can sue, that injured worker can sue the general liability insurer for negligence, the building owner's general liability insurance for negligence under a general liability claim. Because of that, for habitational insurance in New York, their rates are $700 to $1,000 per unit, as opposed to Connecticut, which is about $300 to $500. All because of that one law. So a lot of the reason insurance pricing is the way it is comes down to what are the claims, how much expense is being paid, and then what premium can be charged in order to recoup some of those expenses.
If there's any other questions, please raise your hand. I will follow up with what Sam said, which we're jumping into next is, the recommendations. And we did hear about the third-party litigation funding in our previous meeting. And one of our recommendations is to do a working group so that we can dive into that. We are seeing an uptick of that happen here in the state as well. And while some may be valid, there is a cost to having those cases financed, meaning I think the settling is, a lot larger.
Yes, we think
So
that
to
would
learn
be,
more.
that would be absolutely something that we'd want, from an insurance perspective, something we'd want to address in order to bring that claim frequency and severity down.
All right, any other questions from the group? Do you guys have any, Ben?
I just have you've talked about this sort of being a microeconomic issue. This sort of ties us into the next agenda item, which is if Connecticut as a state made a number of changes to make tort reform and better risk management or more risk management with state contractors, mandatory background checks and fingerprinting and stuff are part of these recommendations. We've heard a lot from providers, from brokers, that stuff is influencing carriers' business planning decisions, none of which has anything to do with the state of Connecticut. We haven't eliminated our statute of limitations on sexual abuse claims. We haven't had any major judgments to speak of related to any of that in these programs in the state. but there was one in Los Angeles, and New York eliminated their statute of limitations. So
Yep.
if we made all of these changes in state statute, would it solve the problem that Lisa has articulated? If we changed, even Lisa's problem specifically that she just talked about related to the indemnification language in state contracts, if we eliminated that by statute, said, Attorney General, you may not use this language anymore, as some states have done. I think Texas has legislation that made that change, in Pennsylvania as well. Like, would the Philadelphia Insurance Company still be making a business decision to get out of the business of health and human services, and would that still leave our health and human services providers, at least the 65% of them that currently use Philadelphia, without a carrier?
Yeah, it's a great question. So what I would say is it's not necessarily a yes or no question. For the state of Connecticut on its own, it would be the job of the broker, in my opinion, and they could have varying degrees of success with this, to explain to the insurance company why Connecticut is different. Because just because we have a Connecticut submission, and this will answer the second part of your question, Philadelphia writes nonprofits in all 49 other states. So they could be taking a bath in New York on claims, and that causes them to look at the whole book of nonprofit insurance, and they're not going to say, maybe they won't say, I should say, well, Connecticut is really good, so we'll just carve out Connecticut and we'll keep writing that, and that would remain to be seen. So to answer your question, it would be the job of the broker to explain why Connecticut is different to the insurance company. And they will either hear that argument or they won't. Depends on the insurance company, depends on the underwriter, depends on the broker's relationship, a bunch of different variables. But just because Connecticut does things one way doesn't mean that's going to affect the entire insurance company's book of business. They may still make decisions because of claims that they're paying in other states that affect Connecticut.
Thanks. That's helpful. I'll just say I've been working in this building for a long time, and this is the first time I've had like as an advocate, as a lobbyist, it's the first time I've had an issue where I can't tell a legislator, this is happening 100% of the time to 100% of the people for this reason. The entire thing is very much relationship driven. Your broker having a good or bad relationship with a carrier, being able to explain things better than another broker, you having, as an organization, having a relationship with your broker, having a relationship with your carrier. You could have an agency doing the exact same amount of piece of work, using the exact same broker with the exact same carrier, getting a different outcome based on the person that they're talking to at the company. It's not a cut and dry, this is happening to everyone all at once.
But Ben, we should understand that the insurance business is relationship based, for better or for worse. Here's the fact, though. Since 1977, there has been active and highly successful tort reform in the Commonwealth of Virginia. The data is precisely and absolutely clear. Go back and look at that data and see what tort reform did for the Commonwealth of Virginia. So we've got an example that is ironclad, has been challenged in court a number of times, never successfully defeated by plaintiff's counsel. Now, that doesn't mean there's no medical malpractice or there's no general liability issues based on the volume of claims in the Commonwealth. But today, in the Commonwealth of Virginia, social service agencies can afford coverage that we can't in Connecticut, and it's because of tort reform.
Thank you, Michael.
I just want to,
Eric?
if I may, address that.
I don't see anyone's hand. Can you just raise your hand so I can see you?
Paul
Who?
Slager.
Paul Slager. Paul,
Yeah, I apologize. I think I waved instead of or
Yeah,
maybe
I
I'm
think
clapping.
you clapped.
Yeah, I don't. I
This
actually
is a
am-
new thing that our working groups have been having. Yesterday's working group was full of hearts and clapping, so I
Yeah,
like this new
right. And
mode.
I actually was sort of want to do the opposite of clapping in response to Michael's comments because I've read the data from Virginia and I've read the data from California, and it's anything but clear. So I think the notion of asserting that it's crystal clear that tort reform has provided a beacon of light in either Virginia or California or Texas or any of these places is a complete fiction. And that data can be interpreted in multiple different ways. I'm very familiar with it. So I don't think it's true. And I also think there's a very steep social cost to that sort of that sort of thing. As we've heard repeatedly in this meeting and in others, it's likely to have no effect on the insurance market for nonprofits in this state, none whatsoever. It's not going to stop the wildfires in California. This is an industry-wide, nationwide problem. So I just don't. I think that some of the blanket statements, Michael, I take issue with. I disagree with them. I don't think they're factual, and I just want to note that.
Let's you and I get on a plane, go to Lloyd's tomorrow, sit down in front of Beasley, and have that debate about Virginia business, okay?
We can do that, absolutely. You set the time, I'll be there. Thank you.
That will be a sub-working group. To this working group. Eric George.
Thank you for your presentation. I just wanted to follow up on something that you said, and Ben made me think of this. It is important to recognize that out-of-state experience cannot be used to impact in-state premiums. And I understand it's easy to use California as an example. California fires do not increase premiums in Connecticut. That cannot be cited as you try to increase premiums as your basis when you go to the Department of Insurance. You'll be laughed out of the Department of Insurance. You would never make that argument. So yes, we have reinsurance issues 100%, and there's trends 100%, and companies can decide whether a risk is something that they want to continue to insure or not. But there's just so much focus on out-of-state experience, whether it is lawsuits, whether it's fires, whether it's hurricanes. Let us just understand that Connecticut rates are based on Connecticut premium, Connecticut premiums are based on Connecticut experience, and our Department of Insurance would not allow for anything other than that.
George?
I just want to add, not to that statement, but to Virginia. I did reach out and talk to my counterpart in Virginia and asked him, are you having issues with foster care and human services, social services types of insurance and nonprofits? The answer was yes. They're still having the same issues in Virginia. Whether it's tort reform or not, they're still seeing issues there.
Okay, we're going to do the last question for the speakers and then move to the next segment. Representative Nuccio.
Sorry, I couldn't find the button. So my question isn't kind of in relation to what Eric George just said. Just kind of a high level question. I always hear that, our rates aren't tied to anybody else's. I'd love to see like the numbers to see how all of that works, because Connecticut insurance rates are significantly higher than other states from the research that I've been doing. And I was wondering if we know, a question came up the other day and I couldn't answer this. And how much does motor vehicle theft, which again, Connecticut is pretty high, considered in that? Like, is there a way to quantify how much like car theft has to do with why our rates are so high?
I don't really have a mechanism to tie that particular or any particular type of claim to the impact on the rest of the insurance marketplace. Anecdotally, I'll use the car theft claim as an example. There's a difference between you locked all your doors and someone smashed in the window and stole your car, and leaving the car door open and having someone steal the car. There's nuance to each claim is basically what I'm getting at, which makes it a little more difficult to just say, hey, this type of claim affects the rest of the insurance market in X way. As someone said it earlier, there's a lot of nuance to the insurance marketplace. And so just because you have a claim, it's also how you had the claim that the insurance companies factor in.
Well, I think maybe helpful, because especially when it comes to the nonprofits and all the conversations that we've heard here, and the litigation is a big piece of it. I've had quite a few people come forward to say, we need to put legislation in that limits the amount of tort, amount of people that can sue or the amounts that they can get in that. But I will tell you, there are probably more lawyers under the Gold Dome than there are anybody else. So I can't see that getting passed. But what is making this one specific population so much higher? And is it based off of people suing or incidents? Like, I would like to understand just, with with health insurance, it's very easy to see how the rates are built up because of the medical loss ratio laws at the federal level that we have to comply with. You can very clearly see, claims and the pieces that go into how a rate is developed. I don't know if we have that same level of detail at the property and casualty level, but I'm interested in the more meetings that I'm at, I still keep coming away with the same problems and questions. Why are the rates so high? What is driving it? And is there anything that we can do about it?
Yeah, so the insurance companies would have the best data on that. What they would give you is most likely a combination of data that includes loss ratio and combined ratio for the book of business. And they'd say, here's my profitability on this book of business. And because of the amount of claims that are coming in, I'm either very profitable or I'm not very profitable. And that's why I feel the way that I feel about this, this industry vertical. So from the insurance company's perspective, the reason that human services and social services rates are high is because they're paying claims. And that can be frequency, severity, litigation, financing, whatever the mechanism that we get the claims, that's from Julie and my perspective, that's what the insurance companies tell us. They say, this book of business isn't performing the way that we want it to, and therefore we need to charge more rate.
Do we, I don't know if anybody there, Carrie from DOI, again, from the MLR perspective, we know in the state of Connecticut, health insurance is pretty regulated. The profit margin on fully insured insurance policies is under 1%. Do we know what the profit margin is on property and casualty?
I'll turn that over to George and Terry.
Yeah, I think companies look for a profit within their filings between 10 and 15% on average.
So they're getting a 10 and 15% profit, whereas health insurance is getting under 1%.
Well, I can't, we had this conversation the last time. I cannot and will not begin to wade into the waters of health insurance, but I see pretty big hospitals adding facilities all over the place. So someone's making money somewhere, in my mind, in that picture. But, we regulate the P&C industry, and it's not unreasonable within any state that a company is looking for a 10 to 15% return on their investment. That's what keeps them to do business in the state. We do get a report that's done by the NAIC that does track the premium costs, what insurance costs in the 50 states. Connecticut's probably at the high end of the top 10, and there are a lot of factors that go into that. We have a very densely populated state. We have people that drive very expensive vehicles, people that drive vehicles that have physical damage coverage. So they want everything. They want high liability limits. They want, physical damage coverage, and their vehicles are expensive. And they're driving in a state that has a lot of heavy traffic in it. And we have accidents and we have lawsuits. So the companies have to provide what their specific data is to our department, and our actuaries review it and determine whether the rate is actuarially justified or not.
So I think you conflated a couple of things there. Hospitals making new buildings has nothing to do with the cost of insurance. Their profitability is separate from, we don't regulate the hospital's profitability, which I'd be happy to talk about, but we don't do that. We do regulate healthcare profitability
But
to
if
under
you look
1%.
I would say if you look at the P&C industry, in automobile and homeowners, we have 100 carriers writing business in Connecticut. If you look at health insurance, how many carriers are writing health insurance in Connecticut? I don't think there are 100. If you had that competition, that would help keep rates in line.
All right, we're going to end there for our first segment. Thank you, everyone. Sam and Julie, you're welcome to stay. We're going into our recommendations. You can leave, but thank you so much. We really appreciate this. It's a great, discussion to have. Next, we'll move into the recommendations. All of us in the room have a printout, but everyone online should have received the email from Mackenzie. If you don't have it, just send Mackenzie an email or a text right now, and she will email that over to you. I'll just look at the recommendations. This is very much a draft. This is everything we talked about, put on paper, and probably stuff that I forgot. So don't think that this is the be-all, end-all. This is just for us to have a discussion on. I will ask, I think the first point is really interesting. It's reducing the risk. and improving outcomes. And we can talk through some of this. I'll read it really quick and then we'll open it up for discussion. We talked about annual background checks and fingerprinting. The industry said that it was very difficult and expensive and cumbersome. Do we look at something like we work with the state police? Does the state cover those costs? Do we need the state police to go into nonprofits to provide this service? We talked about stronger penalties for sexual abuse and molestation crimes. We talked about limiting the statute of limitations. We talked about eliminating the state contractual indemnification language or limit. And we talked about requiring agencies that are receiving grant monies provide claim data and a best practices, just kind of having more of a best practices, and maybe we have a, something that we can share across the industry on how to do that. So those were some of the things that we talked about regarding reducing risk. Any questions or comments from the team? Yes, John.
Thank you, Representative Wood. John Catalin, Connecticut Alliance of YMCA's. I do have some concerns about the annual background checks and fingerprinting. I know the OEC's on the call, so first of all, I'd say I would defer to them if they're able. I know our former Commissioner Bai had numerous conversations with the state police about speeding up the process and making it easier. And some time was knocked off and getting the background checks back, but I think the OEC could have a better explanation. I would add that the recent child care legislation does require the OEC to look at the background check process to try to speed it up. I think because it's burdensome to our staff, I think that we need to make sure that requiring background checks and fingerprints every year is a best practice that would actually reduce the rates. If we're just going to do it for the sake of doing it, I don't see the point of it. I would also add, I know point 2 under A talks about covering the cost of it, but I just want to make the point. It costs $88.25 to conduct a full background check with fingerprints in the state of Connecticut.
And just say that again, John.
$88.25. And thankfully, we've been fortunate that the Office of Early Child Care has picked up those costs for us since COVID. But I would, this would cost just on the YMCA's alone, you're looking at $500,000 a year to conduct the annual background checks and fingerprints. I would also add one more point. One of the reasons we are not required to do fingerprinting of our camp staff is because they have to undergo a background check without the fingerprints, is because by the time the fingerprint results come back, camp's over. And so, the college or high school students start working at camp in June, and by the time the results come back in the fingerprints, they're back at college. So basically, I know there's no such thing as an $88 bill, but you're making us just taking it and setting it on fire because it serves no purpose. So I just want to make those points. Thank you.
No, point well received. And again, it would only be something that we'd want to engage in if it did show a return on investment via insurance coverage. So please jump in,
George. If I could just, I think the only caution I would throw out there, it's not just saving the money from the cost of, running a report. There are organizations out there that can do this, and it may be worthwhile to look into can they do it more efficiently than the state? So companies do use some of these risk management companies to go out and do this in order to get around having the state. Well, they can't go to the state, but there are companies that will do it. I also say, to me, whether it costs $88 or $188, I'm thinking of the kid that could be abused. And so, I understand the camp situation. I personally am not as concerned about a high school kid or a college kid watching kids during the summertime. I'm worried about the person that's running a daycare, running a foster care, that is doing it on a regular basis or coming into a situation, and we do one background check and that's it. Now, whether it has to be done annually, I don't know. But is there a formula where you're periodically checking the person's background to make sure, you have new people coming into a facility delivering food or, coming in, there needs to be guidance there. There needs, they need to be checked. They can't be left alone with kids. There's a lot of things I think that can be done to really create a strong risk management process around it. And I think if you start doing that, one of the things that we had sent out was, hey, maybe there's an immunity built in for a facility that is doing these things on a regular basis, that they can't be sued. There's cases that, there's cases where an entity only had 1% of the exposure, but they're being sued for millions of dollars. And if that entity had a process in place, they should be immune from having to be sued. Just because they had 1% liability, they shouldn't be brought into a suit.
Rep Wood, if I could, a major healthcare system in Connecticut 14 years ago paid $63.5 million in sexual abuse claims. That's an awful lot of $88.25. It was all over the Hartford Courant. No debate about factual accuracy. I was on the committee that adjusted those claims. I think we have to get real about the cost of managing risk on the front end of these exposures. And I would say that one of the landmarks, hallmarks of sexual abuse and molestation claims, one of the issues we must address, along with indemnification and other matters, is the fact that when these claims explode, they are egregiously large. So the math's pretty simple for me. 63 million, you can divide by 88.25, and you can save a lot of lives.
Ben?
I'll just say that I think before we start talking about what the standard should be, we need to acknowledge that there's different, sometimes significantly different processes and standards depending on which state agency holds the contract. And one of the things an organization like Lisa's and many others that contracts with multiple state agencies has to juggle is how do you stay in compliance with both best practices for risk management in your organization, which you need to do to manage your own risk and also to keep your insurance and everything else, and what does the Department of Children and Families require you to do when you hire a staff person compared to the judicial branch, compared to the Office of Early Childhood, compared to the Department of Mental Health and Addiction Services, and kind of manage all of that. And so I think I agree with George that there's definitely some things that we could do as a state to streamline how we evaluate this, whether organizations that are working with kids and other vulnerable populations who are all at this point required to do background checks on the people that they hire that have contacts with their clients, how all of that's managed, the amount of time that it takes to get clearance, cost, all of that stuff is something that we hear from all the time. There was a time, and it's been fixed now, where I know, not to call Mike out in the audience, but I know at the Department of Children and Families, like if you needed to hire your staff person, if there was a holdup, the situation was you called the deputy commissioner and he walked down the hallway and figured out the holdup and unstuck it for you, right? And so there's all sorts of efficiency issues that I think we could deal with, but until we figure them out, it's going to be very difficult to increase the standards because the standards are all different right now. So to make them uniform, to increase them, the starting point needs to be, so why are the regulations in this state agency this compared to that state agency? Is there a standard that makes sense across all the different programs? And once we have the standard, I think it would be easier to have a conversation about, does the Connecticut State Police need to be the entity that conducts the background checks? Do you have to send someone to a police department to get fingerprinted? Or can it be managed in a private setting? Because I think the state police will tell you, no, we cannot send personnel to each contract. There's 500 agencies that contract with the state in the purchase of services system. There's 120,000 people that work in the system across the state. Not all of them have client contact, but still, there's not enough state troopers to do it.
Yeah. So are you saying, Ben, you would rather have a standardization for risk management provided by the state across all agencies so that it's the same? It's like we know what we're getting into. It's not different if we go to each different agency. We have a standardized practice. We could then talk about what that looks like in terms of background checks and stuff and who pays for that. Maybe we have like a state fund for that. And then I also think that if your answer is yes, we then go to, the industry and say, does this risk management profile get us to a point where we've checked all the boxes, or have we left anything out?
I think it would be helpful. My guess is that, like anything related to state government efficiency, that's a more difficult conversation when you engage state agencies who each have their own regulations than I would like it to be, or maybe you would like it to be. But my guess is that yes, that would be helpful, and it'd ease administrative burden on our members who are kind of trying to juggle, who have entire systems in their agencies and spend lots of money juggling a lot of different inefficiencies in how the state contracts. But I will say, and this is my sort of overarching comment about everything in this section, I don't know that we've resolved entirely what I sort of said earlier, what we've been hearing from people about what the industry who are going and trying to purchase this insurance from the industry as brokers and as nonprofits is telling them about why it's getting more difficult versus what Eric and others have said about what Connecticut regulations are supposed to do in terms of only Connecticut losses affecting Connecticut rates. And there seems to be a difference in experience, I guess, from how things are happening versus how they should happen. And I'm sure there's some nuance in there about it. But my concern is doing any of these things maybe doesn't solve the problem, because the problem has nothing to do with what organizations in Connecticut are doing. It has to do with the market adjusting broadly, which managing our risk better is maybe not going to stop the trend of happening.
Just real quick, I would also say to set up a uniform policy for background checks, there also may be, I don't know what they are, but there may be some federal requirements as well, because, child care receives federal dollars, and, for Care for Kids. So I think there may be, I'm not sure, but I just want to make sure we're aware of that there could be some federal requirements as well.
Okay. Maggie?
Yeah, I'll just quickly back up what John just said. That OEC, we do have federal Child Care Development Fund background check requirements. That's not to say that we could go past those requirements, do even more. But we are definitely held by federal, and I'm sure there's some other state agencies that have some federal requirements as well. As a matter of fact, we were just having a discussion with the FBI about some of our statutory language. So that's dictated by forces beyond just state statute. And this has been a very important conversation. I'm so glad. I thought I was going to miss this meeting, so I've been able to attend virtually. And I'm taking this information back around the background checks to our background check unit, because we have a whole unit that is devoted to the background check process in order to help and facilitate the process.
That's good to hear. Yeah, come on in.
Good afternoon, everyone. Mike Carone with the Department of Children and Families. Just wanted to share some points on the background checking process. So we do background checks a couple ways. We do them in-house on providers, and we also sometimes we'll be contracted out to state police depending on the contract or the situation. But also we do registry checks, which are actually free to the department. We do thousands of those a year, and also work along with OEC as well, and some of those for overlapping facilities. So background checks do get done a couple ways. Over the past couple sessions, we've actually had legislation to continue those with some changes in the FBI at the federal level to continue doing those in-house for providers as well. So, thank you.
And Mike, how often are those done, or is it different for each type of service offered?
It can vary, but anytime someone enrolls, a new hire, they're going through that process. Depending on the type of work, they can be annual as well. Depends on the work and the contract they're doing within our division, but I can get more information for that and bring it to the next meeting and follow up with that if you'd like.
No, I don't think you need to do that. I think this was a good thing just for us to talk about. We realize we're not inventing the wheel here. We're just putting things on paper that we talked about. I'm going to move on to number 2. We can always come back to things just to keep things moving along. Create legislation enabling the establishment of a Connecticut domiciled captive insurance company or pooling mechanism. And there's a board of directors, there's enabling legislation, there would be funding for this. I'll pass it over to Michael McGlaris. If Michael, you want to elaborate on this, or Fenwa Liu, just to bring us through how the captive would operate.
I'm happy to offer some thoughts. I can't see Fenwa. Is she actually in the room?
She was online. Let me see if she's still there. Yeah, she's online.
Yes, I am online.
Let me offer some thoughts about this. The points on this section are designed to address something that I think all evidence says is critical: the availability and cost of coverage. Now, before anybody raises their hand and says, but the cost of coverage is going to be exactly the same if you create a captive or pooling mechanism, I want to make one thing abundantly clear. Nobody is so naive, Rep. Wood, as to assume that if the state of Connecticut does what I think they should reasonably consider doing, funding a captive and or pooling mechanism to participate in the commercial market, not to take it over, not to replicate it, not to stand in the shoes of, but participate in the marketplace as a co-insurer of parts of these facilities and their exposures. Nobody is naive enough to say that they must improve their risk profile and lower their claims experience. That's got to happen. But I think we're missing a point, and with some of the conversations I've heard today and some of the comments made. This is an existential crisis. If this isn't resolved, the availability and affordability, primarily of general and professional liability coverage purchased through a package policy mechanism for these social and related services agencies, if we don't solve this, they will start closing their doors within the next 24 months. We're optionless. So what is on this page, very simply, indicates that the state of Connecticut, in my professional opinion, must do something to fund and otherwise create a mechanism that participates, I'll use that word again, participates in the commercial insurance market mechanism of insuring these organizations. And the recommendation before us is an allotment of $50 million to capital and surplus, which should be more than enough to adequately fund expenses, as well as to create enough capital and surplus to leverage the pooling mechanism or the company's mechanism in the marketplace. So I can take questions or we can have comments from Fenwa, but I want to re-emphasize again, we can debate and discuss fingerprints till the cows come home, but you're going to have social agencies closing in the next 24 months and or so severely debilitated that they must get out, for example, of the adoptive care business, which would be a great tragedy. I'll turn it over to Fenwa or to you, Rep. Wood, for further comments.
Feel free to chime in, Fenwa, but I do really want us to consider this option. This, to me, is something that we have to kind of go through the motions on, as I do agree with Michael, and I think all of us in this room are on the same page that we have to do something this session in order to stabilize this sector. And one sector we just got some money on, and everyone's comment was, well, we don't think that number comes anywhere close, but we got a number of about $100 million if this annually if the state were to take over foster services and foster homes. So that's not.
You're talking about a non-insurance solution. That's actually if they take over the services, Rep. Wood. Is that right?
Yeah, we take over the services. If they go out of business, the state would have to step in. I mean, that's the reality of the situation. We're not going to let people not, have these services, but it means that the state steps in and takes this on. And my point is that $50 million is a drop in the bucket, and we should be exploring this. And I guess I'd ask the insurance department, what your thoughts are on this. Are other insurance departments looking at this? I believe we had New Hampshire, which is very new, a presentation, but is this something that the department would support?
We have to look into it. We sent some recommendations over, and a pooling mechanism, a captive mechanism, I think, could have viability. But we've got to probably get a consulting group together to figure out how it would operate, how it would be funded. Because to me, the risk is still the risk, and and as Mike had pointed out, the risk management of it is going to be critical, and the rigor around its operations will be very, very important. So I'm not aware. I was aware. When Eric talked about New Hampshire, that was the first time I'd heard about New Hampshire. But a pooling mechanism could be a possibility, along with considering a captive. But the thing is, with the captive, as we've discussed, usually the members are the ones that are funding that, and they can't sustain $100 million loss, and that's what we have to keep our eye on. Is the risks are still there for these high risk families.
Any other comments, Ben?
Thanks. Yeah, this is, I think, where the Alliance is most focused around this issue. I think there's some pieces that, including the indemnification language and some other things that I think we're interested in exploring, but we agree with what Mike just said, that we luckily are not in crisis at this exact moment, but that we are very concerned that we're a year or two away from that crisis becoming more than 4 or 5 agencies like Lisa's, like Waterford Country School, who we've heard from earlier in this process, who are facing an emergency right now. And let's be honest, there's 500, like I said, organizations that contract with the state, and it's in the $3 billion a year or so that the state spends on nonprofit health and human services. And so if 4 or 5 of them are having a crisis at any given time, the state can figure out a way to, on a one-off basis, get people through a crisis. But if 4 or 5 turns into 20 or 30 or 40 or 50, even if it doesn't turn into 500 immediately, it becomes immediately impossible for state agencies to be able to figure that out. And so getting ahead of it, and it should go without saying, but then there are immediate severe consequences for not just the people who are working in these agencies, not just for the state who's got to manage a system of care, but like for the people who are in that system of care, the residents of the state that are getting services. So I think we have an opportunity to get ahead of it and put something together that would be able to step in. The difference between this industry and other industries that have been using captive insurance companies for many years, like the hospitals, is that we don't have the ability to do it on our own. We because of how the state has paid for these services and contracted for them forever, despite the wonderful progress that Senator Austin and the Appropriations Committee have been able to make the last 4 or 5 years, we're not capitalized where we could make the kind of investment that you would need to make to get something like this going, even collectively. And so the state providing at least seed funding to get it going, I think, would be very important. I'll also just say this is like our second meeting, but there's precedent, right? Even if it's a long time ago, the state did this for municipalities in the late 1980s when they were facing a similar crisis and capitalized KERMA, which is now the state doesn't pay anything towards, and so it's something that's happened before. All I'll say in terms of like urgency, I guess, is that we had hoped that this consultancy would have, that George mentioned, would have happened already. There was a lot of talk in the 2025 legislative session about getting this information together between us and the legislature and the executive branch. Ultimately, dollars were not in the state budget to to outsource a study, but our hope was, even without that, that some of this work outside of this committee would have been undertaken, and it hasn't been. And so whatever happens this session, I don't want to dive into something without knowing all the information and making sure that it will work and knowing what it will cost, et cetera. But I want to make sure that we really do that diving in fast so that we can continue to stay ahead of whatever crisis might be coming.
Rep Wood, if I may, the fastest way to arrive, in my professional opinion, to arrive at a consensus as to what are the best sources, what are the best tools to manage risk on the front end of the exposure of these organizations, is to get the insureds together. Every time you get a group of insureds together who are suffering through a crisis, their professional wisdom and experience on the subject of risk management will prevail. I don't care what industry it is. I don't care what the circumstances are. Most captive insurance companies, and certainly all pools, are founded on one principle. We bear risk together, and on the front end of bearing risk, we develop best practices together because we're the ones suffering through the claims. It isn't the insurance industry telling us how to manage our risk. It's us knowing how to manage our risk through experience. So I would say to you that the best source, the driving fundamental source for the management of the front end of risk of these organizations will be the organizations themselves. They have the claims experience, they've lived through it.
George.
Thank you. Thank you, Rep. Wood. Just a couple of things. I think, Ben, you're right. I think the market has shifted, and it is temporarily, it's filled the void in the fact that it's offering claims-made policies in the E&S market, all right? But, one of the conversations we had with a company and what claims-made does is it really protects a company from long-tail claims when they start writing this business. But, one of the things we talked about, which was very interesting, is when you get maybe 10 years down the road for the business that they've been covering, that company still may not be willing to write the retroactive coverage maybe beyond that 5 years. They might say, we'll provide you coverage for 5 years, but we don't want to go back 10 years for anything that might come up. And so that ultimately could be the next bump in the road, because that will leave the entity that needs the insurance with a void, a gap in coverage, because they can't get that additional 5 years because the company's like, I don't want to go back and cover that period of time. So I think temporarily there's a bit of a reprieve, because the E&S market is filling that void, but it's not known how long they will be willing to do that. And I think we still have the expense, the affordability and availability issue ahead of us. And Ben, you mentioned KERMA, and that is a really good model. I would also say, though, there was another entity called MIRMA, which was supposed to compete, but that entity went out of business because they were run very poorly. And so we have to be very careful. And the thing with KERMA is, yes, they had seed money to start out, very well-run organization. But at the end of the day, they have the taxpayers in their municipality that's there, that if anything happens, that will be picking up cost of claims and situations. Again, you've got that deep pocket, your taxpayers in your communities. So that's where we don't have that with this nonprofit community, and that's where we got to figure out that bogey is very important.
And I think the industry's sort of temporary response for a nonprofit, what it essentially means is that you're self-insuring your stop loss. So whatever's happened to your policy, it could be that you've gone to the E&S market, it could be that you are doing claims made, it could be that you used to have 10 million in umbrella coverage and now the only thing you can buy at any cost is 2 million. What it means is if there's a claim and a loss, judgment, settlement, whatever, and it's not covered by what you're able to buy in the market right now, you're out of business. And so it hasn't happened yet, that exact scenario, but it could. And I think if the industry is saying, we're only willing to cover it up to this level of exposure, whatever that number is, or whatever that level is, and the reality is that all of these nonprofit organizations have a higher level of liability potential than that number. It's an inevitability. Even if that were a permanent solution, it's an inevitability that there will be claims above that number and organizations will go out of business. And so, and services won't be provided as a result. And so figuring out how the state can help get into the middle of that delta, I think, is going to be really important.
Okay, that sounds good. We'll continue the discussion on the captive. It sounds like we're all on board with making that part of the recommendations and pooling. Third, create a nonprofit undersecretary position at OPM along with an advisory cabinet with seats for advocates, industry, and nonprofits. Stay ahead of changes and challenges in the space and to bring policy recommendations to the legislature. I love spending other people's money. It's really easy to just hire all these new positions. Yes, John?
Just real quick, under the previous administration, there was a similar position like this, and it was very helpful to the nonprofit industry, at least from our perspective, that we had someone we could that we could reach out to when we had concerns or issues.
It was one person, it sounds like, in a previous administration. Everyone seems to be shaking their head yes. Ben, do you have comments?
I will just, since OPM's in the audience again, there is currently an undersecretary at OPM, Claudio Gualtieri, who serves this role. His predecessor, Ann Foley, served that role as well under the previous administration. I think John's referring to there was a liaison, nonprofit liaison in the Malloy administration. That position was eliminated after the Governor Malloy's first term, or shortly after his first term during some of the budget problems then. And Undersecretary Foley served the role as continuing to chair Governor Malloy's Nonprofit Health and Human Services cabinet, but the position hasn't come back in the governor's office. I think we have felt for a long time that we are missing that cabinet, but also that cabinets in general that are meant to sort of work out issues with the executive branch are really only effective with the buy-in of the executive branch. And so the fact that it was Governor Malloy's created cabinet and he appointed the people to it and it wasn't a legislative committee made it more helpful than if the legislature had legislated it into existence. Not to decry legislatively existing task forces and work groups, but I just want to sort of caution that I would want to, if we did this, I would really want to do it in collaboration with the governor's office and with the executive branch, because that's really the only way it can be effective. I know that's a frustrating thing for legislators.
No, I mean, it makes perfect sense. And I did make sure Alex got a copy of the recommendations to share with OPM, because I mean, OPM has been at the table and also understands we're at a crisis point. So we would definitely want to have their buy-in to it. So why don't we leave it on as a recommendation with a little asterisk that we would want this to be a recommendation coming from the governor's office, not legislatively. Number 4, a bill from last year seeks to exempt nonprofits from certain state mandated motor vehicle insurance and indemnity bond requirements. Any discussion on that? I know our committee has put this forward every year.
Can I just ask, my recollection from this bill from last year is it would essentially provide a self-insurance option for motor vehicle insurance for organizations that have enough in resources that they could self-insure. Is that like an accurate way to summarize it?
That's what it sounds like.
Yeah.
It sounds like that. Again, I just don't think your nonprofits would be able to come up with the money that would be necessary, because these companies, they file like Avis and they'll file their, insurance with us, proving that, they are self-insuring. So we get a filing from them annually of, I think we've got maybe a dozen companies that self-insure.
One other thing I just think that we should probably keep in mind is that you want to make sure that if this is a self-insurance scenario, that the levels of coverage don't leave the drivers, the owners, underinsured, because that could be an issue. You don't want to jump underneath the state mandated minimums.
Which aren't really.
Right, but you want to make sure that you're not adding to the underinsured issue, because most people have uninsured and underinsured coverage underneath their existing policies, and you don't want to add to that.
Just a question, George, do you know off the top of your head, I'm just looking, so this is modifying a statute that currently allows municipalities to do this for their school buses, basically? Are there,
We have
I just
some
know in my
entities,
municipality, I don't think we do this. I'm curious.
Some towns, I think Hartford is self-insured. I think Bridgeport might be self-insured. And they file a certificate with us. So there are a few entities that, and larger entities like Toyota, for example, self-insured, and they file certificates with our department.
So this is an option that's available for like commercial fleet companies as well?
Yes, for commercial fleet, yeah.
The next one is the working group on the third-party litigation funding. I think we need to dive into that.
Yes, here.
Okay.
We support you, 100%.
What did I miss?
I don't think you missed anything.
Okay, and the department sent over recommendations?
We sent over recommendations. I didn't, do we talk about, tort reform and things like that? How do we go there? Not just third party, but just looking at, because I know like with medical malpractice, when that legislation was passed in 2005, there were caps put on attorney fees, for example. So are there things that, what are you willing to consider? I think putting things on the table for discussion, and what are you willing to, consider?
And George, if I could, we should revisit those, because those 2005 changes were very meaningful, you will recall.
You helped me.
Yeah.
We had to implement it.
I know.
Okay, I will add that to the recommendations. Anything else? All right, we'll send around a revised recommendations for everyone to make comments on, and then we will, if it's finalized or we get it to a point, we can then make sure it gets to the committees of cognizance. Any other questions or comments? Great, thanks everyone. Have a great day.